All right, hello everyone. I'd like to thank SSA for having me speak here. And as I was sitting there listening to Jeff, it sounds like they started up an assembly plant next door, so I'm not sure there's been a capacity reduction just yet. Let's see. So I'm from Standard & Poor's, credit rating agency. Normally that means we're the gloomy speaker at these events, but I think actually today you'll be possibly surprised that we look at the industry as having a pretty good base going forward from here, just given what's happened in the last few years in the U.S. Obviously, we look at Europe as a challenge, but we generally have a pretty favorable outlook in terms of where most of these companies are in terms of their credit quality and what they can sustain going forward. So I'll just give a very, very quick overview of when we do our ratings. So ratings are a relative ranking of a company's ability to repay its debt when it comes due. So it's credit analysis, but it's also a relative ranking. So we put a lot of emphasis on business risk, and then we put a lot of emphasis on financial risk. We go through the country risk, the competitive position, profitability, and then we look at financial risk. And there, we don't really have any magic ratios. It's fundamental credit analysis, cash flow, leverage, the debt structure, liquidity is a big part of it. And then we look at the conclusions on business risk and the conclusions on financial risk, and we have what we call the business and financial risk matrix. So if a company is intermediate and fair, that would imply a rating, say, of BB+. And then just down below for reference, we have some ratios that we look at relative to some of the financial risk metrics. And as we get into this and talk about the rankings that we have on the global automakers and the suppliers, you'll see that most of them tend to be either in speculative grade or low investment grade in the case of suppliers. And I'll come back to the business risk financial metrics later. So in terms of our global coverage, we have about 18 global automakers and 4 global truck makers, and roughly half of those companies are investment grade and roughly half are speculative grade or high yield. And then when we look at the suppliers, there's about 70 rated companies globally, so the obvious household names, plus many others. There's 5 auto retailers, and most of those companies are non-investment grade. Since 2009, we've really been doing nothing almost except for upgrading. So there's been a lot of upgrades since the fall of 2009, but the universe of suppliers is still mostly speculative grade. And then there's other companies, auction companies, commercial parts distributors, and other sorts of companies, aftermarket, which has also been a challenging market. So as it was said at the beginning, these slides will be up on the SAA website, but I'll just quickly run through, in terms of our rankings and the relative default risk, the first roughly half or 3/4 of this page is the investment grade companies, really ending with kind of Hyundai, Kia. And then when you get down into the non-investment grade, it's Ford and Renault. And then on the next slide, you'll see it's GM, and then further down to Chrysler. So, within the non-investment grade companies, all of these each have their own individual story, of course. For the European volume makers, Peugeot, Renault, Fiat, their major issue is obviously exposure to the European market, which this year will probably be the 6th year of decline, as we heard earlier. For some of the other companies, it's more of a mixed story. I'll get into GM and Ford and Chrysler specifically. Obviously, they've done a great job here in North America, profitable at sales levels where they formerly lost and used cash, now profitable. And then some of the higher rated German luxury manufacturers, notwithstanding weak Europe, continue to benefit from exports to China as well as the US. So, if either one of those markets was to weaken, that would be a big headwind for the Germans. The truck makers, I'll skip them. So, we've heard a lot from Jim and Ellen and Jeff as well, just on the macro factor. So I won't spend too much time on that, other than to say, Europe is a big hot button for us. Latin America, we have expectations that things will not decline further there. And China, we expect slower growth than in the past, more of a normalized growth. And our forecast for this year in the U.S. is 15.3 million. Outside the U.S., we look pretty closely at the LMC forecast. And one of the questions we keep asking ourselves in terms of the go-forward credit ratings for either the automakers or the suppliers is just what's the new normal SAR in the US, but especially in Europe, and when does that start to come back? We heard earlier how far down some of those markets are. I'll go into some scenarios at the end for the suppliers, but we think our ratings, the relative default rankings, are sustainable even with a weak Europe, kind of a flat Brazil, and some growth in China. And the last 2 points are important about the capital markets. It was mentioned earlier. This is a very capital-intensive industry, both on the vehicle production side, but also on the consumer finance side. And I'll have some slides later on to discuss that. But we've also seen plenty of refinancing, including GM's expansion of the revolver. So the state of the capital markets really is important to the sector. And then we haven't had any U.S. defaults in the U.S. auto sector since 2009. This is our fixed income side's forecast of the speculative grade default rate. So you can see the peaks in default rates. You can see that the forecast for this year is ticking up to, I think, a little over 3%. And that really compares to basically 0% in terms of defaults for the auto sector. So whereas in the past, we had plenty of defaults in the sector, especially on the supplier side when the economy was doing quite well. Now, if you look at what we call the weakest links, the auto sector is actually pretty good standing. In fact, it's the next to lowest sector in terms of, quote, weakest links. So, you know, the sector at the top, the media sector, is where we see the most potential defaults, and autos is pretty far down. That's also a different story than we would have seen previously. Just a couple highlights here. One is things that we're watching in terms of, can't emphasize the capital markets situation enough. Another threat, adverse product mix if gas was to go back up to $5 or approach $5. But even here, the fleets are much more fuel efficient, even on the large truck side. So we think the product lineups are more resilient than they would have been, than they were back in 2008 when gas prices spiked. The one risk that's out there, and we've seen some examples of this, but with no real effects on the ratings, is just the risk of supply chain. And it's sort of this wild card that floats out there that we try and incorporate when we think about credit risk, but it's really hard to say what's going to be the next impact on the supply chain. Is it natural disasters? Is it raw materials? There was potentially a port strike, which didn't occur. So this is an issue that, from our standpoint, from investors' standpoint, it's difficult to quantify. It's difficult to, it's impossible to predict, and it's difficult to assess how the industry will deal with the next round of supply chain impact. But it's something that you have to keep in mind. I think the one thing that our takeaway has been from these various events recently is that these companies, now have a much deeper view into their supply chain. They now know who to get in the room when these events occur. But it's also unlikely in our view that there's going to be sort of widespread increase in sourcing. That's just very costly. So I'll talk now about the U.S. automakers, and I'll start with a summary of where we are. So, and I'll start at the very bottom point about General Motors and Ford. So their ratings in the last 3 years roughly have gone from either D for default or SD for selective default back up to almost investment grade, so the double B plus. So on Ford, we have a double B plus positive. There's a lot of aspects which I'm sure are going to come up in the questions and answer session, but our main point there is that we need to see more diverse profitability on Ford. So Ford is doing very well in North America, but when we think about investment grade, we think more diversity of profitability, and really that means some prospects for profitability in Europe. So on Ford specifically, we've said late 2013, under the view that would give us insight into the prospects for profitability in Europe. Not that they would be profitable in 2014, but that we would have a better understanding of how the restructuring is going. On GM, the rating's double B plus stable. Again, profits and cash flow in North America, losses in Europe. The evolving ownership structure is something that we look on favorably in terms of the exit of the Treasury, because as Jim said, and we would agree, that crystallizes really what's the amount of capital that could be spent to revise the capital structure. We also treat the Series A preferred of GM as debt that's held by the government. We expect that to go away. Chrysler, B plus stable. They've actually done a bit better than we expected. Any upside on that rating, we do have a stable outlook. The upside on that rating is really how it goes with Fiat and Fiat's own situation, but we do think Chrysler's benefited from the Fiat ownership, not financially directly, but in terms of the management and the oversight. I think the other point is, in terms of financial policies, we do think all three of the U.S. automakers, they're generating cash, they have fairly good cash balances, and they're all very focused on reducing the financial risk, given the fact that business risk remains high. So our next three slides really are just a little bit more of a drill down on the automakers, and I think the main point on Ford is that from a strength standpoint, we're very convinced that the improved cost base, lower headcount, and better traction with the consumers on the product lineup really, especially in the smaller vehicles, is something that's intact and provides a very strong base for where we are on the ratings. Obviously, Europe is a very big challenge in terms of reducing capacity, and that's just a very slow process. So we don't have any expectations that there's any quick fixes there. On GM, again, a lot of similarities. We do see GM's geographic diversity as better than Ford's. We do view their challenges in Europe as significant, if not a bit more significant. The ownership mix we view as temporary, and that's starting to crystallize. And we consider their liquidity, and Ford's as well, to be consistent with a higher rating. So when we think about higher ratings for either Ford or GM, it's not needing more liquidity, it's not needing better profitability in North America, it's really diversity of profitability and some improvements on the balance sheet, addressing the pension, which is also being done. So on Chrysler, again, more leverage there, and obviously very North American focused, which has turned out to be a good thing in the last couple years. Still heavy truck focused. That also hasn't been such a bad situation to be in, but limited diversity, and the Fiat-Chrysler relationship, even though we think it's been a positive, is still a work in progress. So I'll just say a couple words about the automotive finance operations, because obviously, making the products people want to buy is important, but selling to the consumers and having the consumers be able to finance is also important. And we saw that obviously in the downturn when the large banks have gotten in and out at various times of the auto finance business. Now they're back in. Historically, all of these companies had large captive finance operations, which required a lot of funding and required a fair amount of use of the auto ABS markets. I'll get into that a little bit more now. So the next couple slides cover the auto asset-backed security market, and that market has been critical for the FinCos as well as the bank lenders who are financing this growth in sales. So as sales have continued to grow fairly strongly since '09, part of that reason is the consumer finance function seems to be back and operating. And if you look at the upgrades versus downgrades on the auto ABS loans, it's a huge difference. So many more upgrades and downgrades, few if any defaults. So the investors who are investing in this paper and then indirectly financing the consumers have really had experience now that this market and these types of instruments, consumer auto loans, really have performed pretty well, and that bodes well for continuing growth in auto sales. This just demonstrates that the auto ABS really tracks the auto sales, and if the auto ABS experience had been different, that could be putting a constraint on sales, but it didn't. And the other thing that's been talked about quite a bit is just where we are on subprime auto lending, and you can see how low, using the auto ABS issuance as a proxy, how low that issuance got back in '08 and '09. We still don't see especially at the captive level, the subprime side of things has gotten, we don't see that as having gotten out of control or is dramatically being higher than it used to be. But there are some other pure players that have expanded the volume in that. But this has also been a good story in terms of sales. You can see it's still below the peaks of '06, but rising. So when we think about the FinCo side of GM and Ford and Chrysler, historically all three companies had FinCos. Now Ford still has, obviously, Ford Motor Credit, full captive, $100 billion or so of assets. GM purchased AmeriCredit and is expanding with the Alley International assets, still smaller, but we do see that as a further move to return closer to something of a full captive, not as large as Ford Motor Credit in the near term. And then a few years ago, we would have said, if you didn't have a captive, you're really reliant just on the banks, and that could put your sales at risk. But with the situation with Chrysler, so far we really haven't seen that. The banks have come back into the market, and they still don't have the same flexibility as Ford or GM, but they've been able to work partnerships sufficiently to keep the customers financed. I think I've covered a lot of this. There's very many similarities of GM and Ford, but there's some differences. The ratings are the same. We have the positive outlook on Ford, looking at possibility for profits in Europe. We have the stable outlook for Chrysler. And it's really the macro risks are the biggest risks in our view, just because these companies have made a lot of progress in North America with respect to their cost base. Okay, so I'll go through the suppliers, and the next 3 slides are more data than anything else, but you can just see the number of suppliers that are rated globally. If I can flip through this. Yep. And quickly, when you start looking through these, you get out of the investment grade realm into non-investment grade, but virtually every one of these companies has been upgraded at least once, sometimes more than once, since 2009. It's a long list. But so as I said earlier, most of these companies are in this B, double B category. So the triple B